and welcome back to Dukascopy TV. Today I'm joined in the studio by Andrew Harradine and Robert Milway. Hello guys.
Hi Monica.
Hi Monica.
Now gentlemen, thank you very much for joining me both in the studio. We're going to be talking about where to invest in the current financial climate. Now some of the trends that we're seeing is that cash is costly and equities are not too expensive. Talk us through some of the trends. Where are we seeing opportunities at the moment? Andrew, if we can start off with you.
Sure. One of the areas that we're most positive on the moment is value equities in the US. This has been a part of the market that's been out of favour pretty much since the onset of the financial crisis. One of the reasons for this is that value funds tend to be heavily weighted towards financial stocks, and as we all know, financial stocks have significantly underperformed during the crisis. However, we see things turning around here with respect to housing in the US. The improvement in US housing is a positive for the financial sector. We expect loan growth to pick up, and as that loan growth picks up, this will improve earnings at financial companies. So that the value funds that we're talking about are heavily weighted towards banks, and with this in mind, we expect value funds to perform well. It's quite interesting as we've looked for value funds in the market over the last year or so. There's been a significant flight of capital away from these funds as they've underperformed. So I would describe it as more of a contrarian investment at this point in the cycle. And this investment that we're making on the fund side is supported by the work that we've been doing on the equity side, where we're also seeing some value in financial stocks.
Okay. Robin, what about from your perspective, what would you say we're keeping an eye out for?
I think exactly what Andrew just said. So from an individual stock perspective and a company perspective, Wells Fargo is a name that we've been investing in for quite some time. But anecdotally at this point in time, it's exactly the same. The value has been there for quite some time, and they've been staying on the same. The stock has been on the same multiple for the last 3 or 4 years. However, from an operational perspective, we're seeing quite a lot of momentum there in terms of customer growth and in terms of core loan growth as well. At this point in time, it's difficult to see because of the low interest rate environment. However, the value latency is there as a result of when the operational economic climate picks up. They've got 30% of the mortgage market customers, which they've picked up, which they'll then be able to go on and on-sell, cross-sell more products to at a later stage when basically consumers want to borrow, want to take out more loans, and that's when you'll see things really coming through from profits. Okay,
now are there any particular funds or sectors that you're currently favouring, would you say?
Well, to continue the theme of value, a particular sector that I've been looking at and doing a lot of work on recently is the packaging sector, both in Europe and in North America. So these have traditionally been businesses that have been tagged on to the paper manufacturers, and therefore as a result have failed to earn their cost of capital, have been shocking for shareholders. There's been very, very low growth to the point of poor returns for all investors. Recently, the last 2-3 years, we've seen consolidation both in the North American market and also in Europe. That's meant a few key 2 or 3 players in both markets have been able to gain pricing power. They've got scale. They're able to turn their assets better in the sense of making their cost of capital where for decades they'd failed to before. And a particular stock, for example, in Europe, who's leading the consolidation is DS Smith, who happens to be a small and mid cap, which again is another sort of sector that from an asset class, maybe if you call it, from that we're also interested in. So small cap and packaging.
Okay, now Andrew, what about you? You're ahead of our long-only research. That's your kind of field.
Long-only fund research.
Fund research. Yeah. So what areas are you particularly keeping an eye out on?
I think one of the key issues on investors' minds at the moment is duration risk, and with US Treasuries currently trading close to at all-time lows, with talk of the Fed withdrawing QE. There's a concern that rates are going to rise over the coming years, and it's important that investors protect themselves for when that comes to pass. There's a couple of different types of strategies that we can invest in to protect ourselves from that type of environment. One example would be bank loan product, which has a floating rate characteristic. So when rates drift up, the returns on those bank loan funds will also increase. We also see bank loans as being an attractive relative sort of risk reward versus high yield at the moment. So bank loans is certainly an area that we're interested in. Another area would be short duration Asia local currency bonds. We see a lot of value in Asian currencies. If you look at the Asian currencies on, say, a purchasing power parity basis, they're all looking incredibly cheap at the moment, and with that in mind, we favour some of these Asia short duration local currency bond funds.
Andrew, Robin, great points you both have made there. I'm sure will be very interesting to our viewers. Now, before you guys run away, I want to ask you our Dukascopy question, if you will. Namely, if you have $1 million to invest for 1 year, where would you choose to invest them?
I would put my $1 million into equities. I think if you look at the alternatives, the returns you're going to get on bond markets globally are generally pretty low. Cash, your returns are going to be negative on a real return basis. I think the oil market at the moment doesn't look particularly cheap to me. So equities would be my preferred choice.
Robin, would you agree? Are we in consensus?
Monica, equity, absolutely. Firstly, thank you for giving me $1 million, but secondly, a basket of individual equities, a few choice-selected equities, the majority of which that we are looking at probably yield around 10% cash flow yield at this point in time. That's a phenomenal cash flow, and so there's a lot out there that is value. Maybe not at the aggregate, maybe not certain sectors, but specific stocks, there's still a lot of opportunity there, I think.
Okay, fantastic. Great to hear from you both. Thank you very much for coming in today.
Thanks, Monica.
Well, that's all from myself, Robin and Andrew here in the Dukascopy studio. Please do click back for more exclusive interviews. Bye for now.